In this last example for Chapter 14, we'll take a look at calculating partnership capital accounts over a 3-year period where different things are happening and see how that plays out. Also, you're asked to do some closing entries, which once you have the calculations from the Part A of the analysis of all the capital accounts, that's simple. It is merely distributing the income out of income summary to each of those capital accounts. So here we have 3 partners in a retail appliance store partnership. It was formed on January 1st of 2019, with each partner investing $45,000, so they're even at that point. Here are some of the terms of the partnership. The net income is divided 40-40-30 if it's not sufficient to cover salaries, bonuses, and interest. Net loss is allocated equally. Net income is allocated as follows if net income is in excess of salaries, bonus, and interest. So they've got 2 different ways to allocate the net income. Monthly salary allowances are provided there to the 3 different partners at different levels. Brianna is to receive a bonus of 8% of net income before subtracting salaries and interest, but after subtracting the bonus, so we'll have to take a look at that calculation. Interest of 10% is allocated based on beginning of year capital balances, and then anything left over is allocated equally. So as long as it can cover the salary, bonus, and interest, we'll use everything from 2 or 3 on down. And if they can't, then we have to go back and do the allocations as they're described in number 1. You see different salaries here. You see somebody getting a bonus, and that usually has to do with the type of responsibilities the individuals are taking on with respect to the partnership. Brianna here might be the manager, or they might be grooming her, so they're putting her on a lower salary, but a bonus situation that you can structure that pretty much any way that the partners will agree to having it set up, right? And then with partners and partnerships, the way to get money out if you are not intending to repay it is through withdrawals. So we do these allocations to get the capital accounts aligned in the way that they want to reflect the activity. But when it comes down to it, you invest money, and if you take it out, it's titled a withdrawal. And on the tax side, it comes across through a K-1. Okay, so we're just looking at how these things affect the capital accounts. Here you have your income or loss for each of the 3 years. You have additional investments here from the 3 partners, and then you also have in 2019, and then you also have withdrawals in each of the years. All right, so let's take a look on how to lay this out, the schedule of changes in the partners' accounts. So in 2019, they started off even 45, 45, 45. And then based on the information we have up here, there were investments of 15, 15, and 6. So 15, 15, and 6. Now it's 60, 60, and 51. Then we reflect the withdrawals right here, 17, 7, 32, 17, 7, 32. Right, so that brings us to the point where we have a loss to allocate, and in the information given, the losses are allocated evenly. So at the end of December of 2019, the capital account balances look like this: 41.2, 51.2, and 46,000 for a total of 138.4. Those are the starting balances for 2020. Right? If we go through 2020 here, the only person that added any capital was Phoebe, so $6,000 is being reflected here. The income is not going to be enough to cover the salary bonus and interest allocations or interest percentages that were described above. So if that is the case, we divide the income 40, 30, 30, right? And if you go back up here for a second and we look at the income of 27,000 and you look at the monthly salaries and some of these other, the 10% interest and so forth, you can see that that is going to be more than 27,000. So that's why we default to this number one allocation. And then at the end of 2020, right, we have capital account balances of 35, 52.3, and 56.9. We also tick off here the withdrawals, which become the balances for the beginning of 2021. There's one additional investment here by Phoebe again, so that gets added. And now, because the income is 120,000, we should be able to cover the salaries, the bonus, and the interest, right? So first off, start with the salaries and those dollar amounts that were provided in the chart times 12 give us 42,000, 30,000, and 18,000. So there's a $90,000 salary piece that we have to deal with. We have information on the bonus up here. Brianna is to receive an 8% bonus, 8% of net income before subtracting salaries and interest, but after subtracting the bonus. It's a little bit tricky to calculate, but the calculation is here. So her bonus is 8% times net income minus bonus. So you have to do a little bit of extra math here. 8% times the 120,000 net income minus the bonus is equal to 9,600 if you separate out the pieces in the parentheses. 8% of 120,000 is 9,600 minus 0.8% of the bonus. Solve for the bonus, and the bonus is $8,889. So that's allocated to her, right? This isn't necessarily what they're going to see in cash, but it's an allocation out of the income that increases her capital account. The interest is 10% on the beginning balances, so 10% of 35,000 is 3,500. 10% of 52.3 is 52.30, and 10% of 56.9 is 5,690. Right, so where you're at here is not quite at the 120,000. If you add these up, you'll be short $6,691, which is the residual, what's left to get to the 120, and that's equally divided according to the instructions that we have. You know, you have to round at times, so usually there's a rounding partner identified. It doesn't really matter in this case. They put it to the middle partner, right? And then from there, take out the amounts they withdrew and get the new capital balances. So you have 3 years with slightly different situations in each of those 3 years to see how the terms of the partnership agreement would apply. As far as the closing entries go, you are going to find the line for the income in each of these years. In the first one, the loss allocation is $1,800 each. In the second, we have the income allocation, the 27,000 is allocated in this fashion. And then in 2021, it would be the allocation right here of the 120,000. So we just have to close out the income summary where revenues and expenses have been closed to the capital accounts, okay? Notice we're closing a loss here, so the capital accounts are being reduced. Income summary would have a debit balance, so it's credited. And then in 2020 and 2021, we have income, so the capital accounts are increasing. Right? I hope that's been helpful and that you can finish up the homework based on some of these examples.